Good day, everyone, and welcome to Pathway to 17 Summit. My name is Sephutile Mhlongo. I'm currently the Manager Financial Regulation and Supervision with Digital Frontiers, and I will be the moderator for the session. This is our final session within the Inclusive Green Economy stream and is titled Sustainable Capital Markets Development. This session will seek to explore how emerging economies can innovate for and develop resilient, climate-responsive capital markets. And it aims to share insights on the feasibility of developing a sustainable finance ecosystem to connect capital with opportunities in the ESG space, creating platforms to provide information, access, and transparency on a wide range of sustainable green and social investment products like green bonds. Thirdly, we'll also explore how regulators can eliminate greenwashing and provide transparency that investors need to match their investment goals with ESG opportunities. And finally, we'll also touch on new ways of thinking and operating that can be adopted for climate responsive capital markets. I am joined by a panel of experts, and I would like to invite each of them to introduce themselves for just within 30 seconds. And I will start on my screen. I'll start with Philippa.
Thanks, Sephutile. So I'm a banker turned fintech person, and now I focus on strategy and investment across emerging markets and also developed markets with a particular focus on ESG.
Yeah, thank you, Sephutile. My name is Victor Nkiiri. I'm a capital market specialist. I work with FSD Africa and have over 20 years experience in capital markets. I'm also a climate finance specialist and have worked on quite a number of sustainable finance projects across the continent, including some of the first green bonds that have been issued and also some of the first social bonds like gender bonds that have been issued in the continent. And FSD Africa operates across the continent, and we currently manage projects in 33 countries across the continent. Thank you.
Thank you. Dr. Dalal.
Hi, my name is Dalal Assouli. I'm a faculty at Hamad bin Khalifa University in Qatar. I'm also a GIFT board member, focusing mainly on digital sustainable finance development in the MENA region.
Thank you. And I'd like to invite Elizabeth to introduce yourself.
Hi, everyone. Thanks, Sephutile. My name is Elizabeth, and I am the CEO of the African Crowdfunding Association, which is a nonprofit organization based in South Africa that gathers all of the crowdfunding organizations on the continent. I also run a network of female investment professionals called Women in African Investments. Thanks.
Thank you. Before we continue, I would just like to take a few seconds to frame the discussion and provide definitions of some of the concepts we will be exploring today. So by definition, capital markets are where trading of funding instruments such as shares, debentures, debt instruments, bonds, etc. occurs. It is a source for raising funds for individuals, firms, and governments. So when it comes to sustainable capital markets, then by extension, we're speaking about where financial instruments aimed at influencing environmental, social governance or ESG behavior and alleviating the negative impact of climate change. So these include green, sustainable and sustainability-linked bonds and funds. So where these are traded. So to start us off with with our discussion, I would like to ask Dr. Dalal the first question. And if you joining us through Subcard have any questions, please pop them in the chat. We'd be happy to expand on those as well. So Dr. Dalal, in the development of sustainable capital markets, what steps can financial regulators and policymakers take to ensure that these are inclusive?
Thank you, Sephutile. I think if we look at the development of the sustainable finance landscape for the past decade, we've seen that the innovation has expanded to various segments in the financial industry, and that includes the equities and bond markets. And most of these trends were until now voluntary and market-driven in most of the jurisdictions. mainly driven by investor demand, specifically impact investors who look into products that integrate social and environmental impact beside economic performance. And we've seen that the early adopters who supported these products have also initiated some initiatives such as frameworks and principles, and also some initiatives that support expanding these products in the wider financial industry and the capital markets. Now, this trend we see now that, especially following the COVID-19 pandemic and the mobilization to achieve the Sustainable Development Agenda and to mitigate climate change, has actually changed in some jurisdictions with the support of the regulators. So it's now regulatory driven. And we've seen that, for example, in Europe with the taxonomy for sustainable activities of the European Union and the other regulations of sustainability related disclosure, for example, in the financial services sector. Now, in a lot of jurisdictions, we still see that the focus for sustainable finance products targeting the capital markets is still focusing mainly on the green aspect, because sustainability would focus on green, social, and also governance aspects. So if we look at the broader ESG, so that's why we've seen the development, for example, of green bonds and other green products, for example, when talking about investment funds, green investment funds, etc., with focus, for example, on clean energy, and waste management, in some countries also green buildings. Now, what we want future in order to ensure inclusivity, we do need to scale up the social aspect with more innovation when it comes to sustainable products that focus on social activities, for example, with more social impact bonds and sukuk, talking also about the Islamic financial industry, and also with more investment products in the investment funds, for example, industry targeting also social objectives. Now, this has been a challenge for now, because we still have the misunderstanding that when integrating social impact, it has to do with charity, which is a misunderstanding among, for example, issuers or even some of the investors. But through financial innovation, we have seen some very good examples in Southeast Asia, but also in Europe, where products targeting social objectives can also be profitable and can achieve both social impact while achieving performance and other economic objectives. And I think with the push from the regulators through clear taxonomies that also look at the social aspect, like we have seen for some of the green taxonomies, which look into the breakdown by sector and also the sub-activities under each sector. We do need something similar when it comes to the social sector. And then also with integrating, for example, impact assessment methodologies, which also would provide some transparency for investors. We also need to integrate some of the other segments and creating more synergies. And I think policymakers play also a very important role in that. Talking specifically about the broader sustainable finance landscape, which includes also Islamic finance in many jurisdictions, which is one of the key components of the financial sector, talking, for example, about the OIC region broadly, and, for example, the MENA, etc. And that means that there is a large segment that is still underdeveloped in these regions, which is the Islamic social finance segment, which also has a great potential in terms of suggesting products that ensure inclusivity and social progress and well-being in many countries. So I think the challenge for regulators, or one of the areas that require better focus on the policy side and regulators, is to create synergies among all of these segments, provide work on detailed taxonomies that facilitate, transparency, and also standard definitions of what we mean by certain sustainable labels when it comes to especially the social objectives and activities. and also providing incentives for issuers and funds, for example, to develop these products and attract more investors.
Thank you. I think those are very insightful. That was a very insightful response, drawing in from your experience in Islamic banking and what inclusivity looks like in that space. Just briefly, if it's okay with you, Victor, I'd like to bring you in because you had mentioned gender bonds, and I think that's still very relevant in terms of how do we make sustainable capital markets, how do we make them inclusive?
Yeah, thank you, Sephutile. I think that's a good question, and really how to create relevance, especially in the sustainable finance place, and just ensuring that we are also not crowding out any of the other economic activities, but rather they're complementing each other. So all these financial instruments that basically are used to promote sustainable finance in the African economy are seen to be more complementary rather than competitive to the other tools that are being used in the economy. This is both public and private instruments that are being issued by both the government and also the private companies. Let me pick, for example, we have supported the first 2 gender bonds that have been issued in Africa. The first was issued in Morocco early this year in January by a bank, and the second was issued in Tanzania by also a commercial bank. The one in Tanzania really stands out because it's the first time actually we've issued a sustainable bond in Africa that had a greener. A greener simply means that the bond was actually issued at a lower interest rate than the government risk-free security of the same tenor. We didn't expect this really, but this just goes to show you that there is such a huge demand that the investors themselves on this gender bond for this commercial bank in Tanzania were more interested in the impact that the bond had to the community. And to our pleasant surprise, most of the bond was actually sold to the bank clients themselves. And over 50% of the investors in the gender bond in Tanzania were actually female. And that was just really, really interesting to see such a tangent. The projects have already started being implemented by the bank. We are tracking each of the projects, reporting on the impact that is happening from this issuance. And we've already started actually supporting other countries across the continent to issue such socially focused bonds that are transforming lives. The issue with most of these sustainable instruments is, of course, they have an extra layer of reporting, whereby once you issue the bond, the funds are ring-fenced for the projects and cannot be used for any other projects. And then there is an annual reporting that the investors must track this particular reporting. This, of course, has really helped promote deeper and more liquid capital markets, which are very fundamental to the growth of the long-term domestic savings in the economy. We have found also that across the continent, the biggest private funds pool that we have are the pension funds. And the pension funds are really, really growing across the continent in each country in Africa. Of course, Namibia stands out quite significantly because the pension funds in Namibia compared to the GDP ratio is over 90%. Countries like Kenya is about 13%, countries like Nigeria is at 7%, though Nigeria holds the largest pool of pension funds, second to South Africa, with about $30 billion of pension funds. What we are finding is that most of these big pools of private capital have limited diversification, and most of them are invested in government securities. So these are, of course, high yield, short-term government securities that are disincentivizing many of the pension funds from diversifying. So many of these instruments in the sustainable finance in the, that are being issued out are really providing very, very good options for pension funds to invest. For example, last year we promoted the issuance of the first green sukuk in Nigeria. This was a power producing company that issued the green sukuk. It's the first of the kind in the continent and was really, really embraced by the investors because they were looking to diversify the different financial instruments that they are holding. And we are looking to issue the second series, hopefully very soon. And now we're working with different, even government agency and subnationals. For example, we're working with some of the cities that are the coastal cities and to see how to issue bonds to manage flooding in the cities, you know, flooding risks and all that. So this these are all instruments that are really promoting the economies for these particular countries, reducing the risks that are seated there. As you're aware, the whole of Sahel region is currently exposed to drought. And we have seen what has happened to Lake Chad, for example. The drying out of Lake Chad has created massive insecurities as the communities that depended on that lake are now fighting with each other because of the shortage of food. So preservation of such natural resources as Lake Chad, not only does it bolster the economy, but it also creates it's a type of a security within the different countries that are being affected by this. Yeah, thank you, Sephutile, back to you.
Thank you, Victor. So you brought up a lot of around what is happening on the continent, on the African continent, in terms of like sustainability bonds. It was interesting that you brought up that they are ring-fenced, and I don't think that's something that comes up a lot in conversation that, you know, and perhaps if we have time, we'll go in deeper into that in terms of if these bonds, if these instruments are ring-fenced for sustainability related products, do they crowd out other, you know, development priorities that countries have, and to what extent? However, in keeping with the conversation on financial products, on the different products that exist, I'd just like to bring in Elizabeth to the conversation. You know, through your work with the African Crowdfunding Association, supporting African countries in establishing regulatory frameworks for crowdfunding, which is another avenue that of raising capital for development. Why do you think, why in your opinion or from your experience, why should policymakers and regulators concern themselves about sustainable capital markets with crowdfunding as a market tool, given that especially in the African continent, it's still in its nascent stage of systems building?
Thanks, Sephutile. It's a great question, and I think Victor's response is very pertinent in demonstrating that we're in an area of systems change, and if the capital market is going to play its role to accompany a country's economy along a very complex transition, then there are going to be some basic long-held assumptions that are going to be called into question, like maximization of shareholder value as the holy grail, or continued GDP growth as the holy grail of what a capital market should be doing. And although those questions might feel quite existential for the capital markets world, I think we do need to move past that and embrace innovation as much as possible. And crowdfunding is one of those innovations where you get to rewrite the rules. You get to have a blank page. You get to write a new regulation. You get to engage all corners of the capital markets, not just the public ones, but the private ones. crowdfunding is an interesting space where you do have private companies that are raising publicly. So you get to deal with retail investors and sort of deep dive into what they care about. How do they feel about the climate transition? What are their anxieties? How are they thinking about new trade-offs between financial return and impact? As Dr. Dalal was saying, Islamic finance is a very interesting space for those reflections too, because it's a lot of personal and sort of religious motivations for placing your savings in different investments. So even though crowdfunding is nascent, I would say we're at a pretty nascent systems change point as it is. And so, openness is the order of the day. But to speak more practically, crowdfunding is useful as a part of capital markets in which small-sized investments need to be done efficiently and at scale. Crowdfunding technologies, particularly with the introduction of blockchain, sort of the Algorand, blockchain being extremely environmentally efficient, it is a new way of processing small-sized investments efficiently. And a lot of the innovations and businesses that are working in the space of climate transition actually require capital amounts that are still very small. So it's much smaller than what private equity or venture capital can get interested in. Obviously too large for what microfinance can do. So we kind of fall into this sort of age-old problem of missing middle, and crowdfunding it needs to play a role in that space. But beyond the issue of size, and just to give some color to what I'm saying, I mean a $100,000 investment or $200,000 investment. But it's not only an issue of size. There's also, as we mentioned, the stage that we're at, where we're entering into new business models. We're discovering new business models that are not necessarily going to be compatible with the sort of return-seeking profiles of the investors in our local markets. And crowdfunding, by virtue of it being cross-border and flexible, is able to go and find pools of capital, pools of liquidity, whether they're local, intra-African, in the diaspora, or amongst Europeans and Americans that are sort of impact-oriented. They're able to tap into pools of capital for projects in Africa, which might not be able to find the capital locally. And so you get a more thematic way of investing, you get a more personalized way of investing. And that's an important, I think, feature of crowdfunding. Another feature, and I think this goes to what Victor and Dr. Dalal were saying too, is that we can't really talk about a sustainable capital market in terms of climate only. It does need to be social. We have to have a just transition. We know that we need regulations that recognize that climate change is going to disproportionately affect the people who had pretty much nothing to do with it: poor people, rural people, women. And if you look at the projects that crowdfunding platforms are facilitating fundraising for, and you look at the ultimate beneficiaries of those projects, a lot of those beneficiaries are in those groups, and that is really, really essential. To give you an example, if you go to a German platform that's been going for about 10 years now, called BetterVest, they're currently raising about 200,000 euros for a hydropower plant in Kenya that's next to a river, where they estimate that there's going to be about 1,000 tons of carbon emissions that will be avoided if it's put into place. And the people that are putting this money in are impact retail individual investors in Germany that are impact oriented and I feel deeply that this climate transition, this climate change is a deeply unfair, unjust phenomenon. And so that's a powerful way to be allocating your capital. Obviously, we saw the reception of the company Patagonia's change in its governance structure. These types of governance structures can be put on crowdfunding platforms. They can be marketed for what they're worth, right, for those values. And I think that flexibility of crowdfunding to sort of better match these individual investors with those values that these companies are upholding is really, really powerful. So yeah, that's, I hope, enough good reasons for regulators to take crowdfunding seriously. We could talk a bit more about the actual underlying technologies that make it in itself a more climate neutral or carbon neutral technology, but I'll stop there for now.
Thank you, Elizabeth. I think in your response you covered quite a lot, including and touched on features of like the feasibility of how feasible is it and what does that look like for, you know, in the African context. But you also touched on a couple of interesting things around the, you know, you mentioned blockchain and the technologies, although it was more of highlighting that these exist within the crowdfunding space. But I'd like to use that to link to Philippa, who has, you know, your work is in around the space. So my question to you is, you know, given that we live in this era of unprecedented digitalization and innovation, you know, what are the opportunities and threats presented by our digital ecosystem to the development of sustainable capital markets?
Thanks. So I think when we think about the digital ecosystem, we think often about innovation, we think about validation, we think about reaching scale. And when we apply that to the capital market space, there's really two different directions that we look at. So there's the assets and actors within capital markets on the one hand, and then there's the infrastructure for the capital markets on the other. A number of the panelists have spoken about sort of various kinds of green assets, green bonds, and how we try and facilitate finance into sustainable investments. There's a lot of work being done by technology companies around data and transparency, using Internet of Things devices to get more information into asset pricing, more AI, better analytics, and some of the taxonomies that are being developed to better price bonds, equities, and alternatives from a climate risk and sustainability risk perspective, and really embedding that in thinking. Initiatives like the London Stock Exchange, for example, ESG anomaly detection solution. So saying, do we think companies are actually disclosing effectively, appropriately, and are there any big gaps from disclosure last year to this year, and can we find out why, just to make sure that companies are all approaching this in the right way. And I think technology also enables wider participation. Victor touched on this briefly, but both democratization of access in the kind of crowdfunding sense, but also more diverse participation, ensuring that investors who are motivated to support sustainable outcomes are participating in the capital markets as well. On the infrastructure side, and particularly when we talk about emerging economies that are entering into this more developed phase, it's important that we get the right technology in place. Blockchain can be very useful, but we've got to be aware of potential climate impact of some of those technologies and setting up effectively for the future so that the capital markets themselves are sustainable. Use of smart contracts could actually be used to embed some performance-based targets in funding structures as well, but making sure that really that infrastructure is sustainable. And a potential risk there, if we move towards greater decentralization, where the capital markets continue to have as much control in this space. I think also something we need to learn from the digital ecosystem, and something that Dr. Dalal and I work together with colleagues at GIFT on, is really collaboration. So taxonomies are great. There's a lot of international standards coming together, but we need to make sure that we're not working in silos, even in silos within markets, but particularly globally, because this is a global issue that we need to work together on, and to bring learnings around best governance, innovation on products, and innovation and technology to the fore, so that we can all progress faster and be investing as impactfully as possible. I think to kind of touch on profit and purpose as well. B Corps are a great example, actually embedding in articles of association this balance of not just shareholder returns, but also a commitment to social and environmental positive impact, and equipping boards to actually think about that as they enter into this. And I think that's particularly important as we look at how people structure their business propositions at an IPO stage, but also monitor ongoing success of those organizations.
Thank you. You've touched on a lot of things there, but I would just like to, because I know that Elizabeth has to leave us before we end our call. So I'd like to go back to her and I'll ask this question to her, which is around what are the new ways of thinking and operating that market participants should consider adopting for climate responsive capital markets? You know, what do you think are the new ways of thinking, rather, since we're on this topic?
Yeah, I think it's a great question. I am interested in the interface between private sector, so fintech organizations and regulators, and how we should be thinking about industry associations and the role that they need to play in bridging a number of gaps between market participants, particularly retail investors, and regulators. So, and I think this kind of ties into the issue of sort of low levels of financial literacy, you know, other barriers to participation in markets. And through my experience with regulators, you know, we ask a lot of questions like, what can regulators do to you know, improve financial literacy? What can they do to improve access? How can we democratize? But the question is also, you know, what can they do with the resources that they have? They do not have unlimited resources, and in the African context, they typically are, you know, under-resourced. And so we need to look at industry associations and other networks, and recognize the trust that can be built within networks between market participants, and how to sort of leverage those trusted relationships to bridge these gaps with regulators. And so regulators, for example, can learn more about the content delivery channels that these fintechs are already using, whether it's apps on smartphone or USSD, social media, gamification, other ways to deliver sort of unbiased educational content and taxonomies in whichever way that they're developed to the mass market. These relationships can also help the regulators think about sort of risk-based thresholds of participation that we could develop for retail participation. So, you know, if, for example, if you're living in Kenya and you go through a process or some tool that allows you to think about your portfolio of opportunities and the risk that each opportunity that you actually can access represents and how you should be thinking about that, you're going to be able to better understand, you know, should you go for that public listed instrument, or should you go for a crowdfunding thing, or how much of your capital should be committed to these different asset classes, that they make it real for those participants, instead of you know, your sort of textbook stuff, pension funds, real estate, whatever. You've got to get into the financial universe of individuals and place these new products across a risk return spectrum and make sure they understand it in their own terms. And I think that these trusted networks and industry associations are important places to figure that out. Obviously, industry associations can also create standardized content and taxonomies themselves. If they are, these associations tend to be sort of donor funded, sort of intrinsically non-sustainable, but with partnerships, for example, with FSD Africa, which is a really critical organization also in bridging that gap, these industry associations can actually reduce the burden from the infrastructures, right, or from the crowdfunding platforms or from the other participants, so that their business models are more sustainable too. And in doing so, you know, what the regulators are effectively doing with the regulations and with these partnerships with industry associations is enabling new business models of investment, right? New capital deployment business models in the market. So, and in doing so, you're enabling other pieces, moving pieces of the ecosystem play a stronger role in preparing issuers, for example, for the markets. They're going to be able to do a better job of educating angel investors, for example. They're going to be playing their role more effectively. And so I think that this new way of thinking is more to look at, you know, the capital markets as a constellation of players, with trusted networks actually exercising a really important role in bridging the gap between private sector and regulators, if that makes sense.
Thank you. That's a beautiful imagery there. The capital markets as a constellation of players like the stars. Thank you for that. I would, you know, I think both you and Philippa have touched on collaboration and partnerships as being key towards developing sustainable capital markets in emerging economies. And I'd like to also bring in Dr. Dalal. You know, we've spoken about inclusivity, technology, touched on data and other things. What would you say are some of the key considerations in the discussion of development of wider sustainable finance ecosystems in emerging economies?
Thank you, Sephutile. I think one key issue, especially when talking about emerging economies and developing sustainable capital markets, I think the starting point is to look at the development of capital markets themselves, because we've seen that in a lot of emerging economies, the development of capital markets and therefore sustainable capital markets products faces a number of barriers, which includes, for example, underdeveloped domestic bond markets, insufficient pipelines of bankable assets and of standardized green and sustainable projects. There's also a lack of commonly accepted, for example, green or sustainable standards, definitions. And of course, from the perspective of investors, also looking at the views on the costs versus the benefits of the products themselves. So challenges to scaling up the market would also include the lack of awareness. And we spoke about one critical aspect, I think, that Elizabeth mentioned, is the lack of financial literacy, since we're talking about inclusivity. And inclusivity, one of the key actually enabler for it would be also financial literacy. And we've seen that some of the most vulnerable groups, for example, that suffered from the pandemic and were, for example, MSMEs and, for example, small farmers, women entrepreneurs, etc. And one of the key issues for that was that they lacked financial literacy skills, which made them unable to access some of the products, but also to have access to emergency funding to cover, for example, the fixed costs of their businesses. Now, I think one of the key areas to look into in that ecosystem, so of course there are it's a multi-stakeholder responsibility, and that would require, for example, from the regulator's side, developing sustainable pipeline, for example, of sustainable projects, and that would include social as well as environmental projects, which provide more visibility for investors in terms of, for example, the investment options they have access to. And there is also, on the other side, creating synergies between all of these segments that I mentioned. So you have sustainable finance, sometimes of what we call ethical finance, Islamic finance, etc. So which target sometimes different investor bases. So creating synergies among all of these segments would enable a wider ethical investor base that can be targeted, and which would help us also scale up the market. And then, as I mentioned, a lot of domestic markets are still underdeveloped, and having deep and liquid, for example, secondary markets for the development of sustainable bonds and sukuk would help scale up the market, but also develop the domestic markets. And that would be also very important for transparent price discovery mechanism, for market making, etc. And then there's also the the importance of financial innovation. I think it was mentioned also by the earlier speakers that we do need to have environmental and social structuring considerations when developing product, and this should be also inclusive in the sense that it targets also the vulnerable groups, as I mentioned, like MSMEs or small farmers, etc. And this, of course, I think leveraging on fintech is also very important. So in that ecosystem should also enable the development of both sustainable finance and fintech, because fintech is an enabler actually to sustainability. And we've seen that, for example, through products like crowdfunding platforms or social impact bonds, etc., that help achieve that objective. On the other hand, some of the enabling factors could be, for example, the support from DFIs or multilateral institutions that have various tools and instruments to support, sustainable finance development. For example, when we saw the developments in the green bond market, I think having the first green bonds supported by institutions like the World Bank, etc., provided a kind of confidence to the market and to the other issuers to enter the market. So we do need the same thing in other jurisdictions, in addition to also promoting effective risk management tools. And other areas to look at in that ecosystem would be, of course, what we mentioned earlier about standardization. So standard terminology about, the green label or the social label, etc. So what qualifies as green or social or sustainable, providing also more credibility and transparency to investors. And that is true. We've seen in the case of green bonds, we have a third-party opinion, but also frameworks or principles, and that all supports, credibility, and also later on impact assessment with sustainability reporting, sustainability rating, etc. And then finally, we've seen that some governments, some countries, for example, when the first SRI Sukuk were issued in Malaysia, it was supported by incentives, for example, from the government. And I think tax incentives or regulatory treatment of certain products, as well as some of the green or social policies, would help scale up the market and support the developments of more innovation when it comes to the variety of sustainable finance products that can be offered. And I'll throw back to you, Sephutile. Thank you.
Thank you. Thank you so much. We have about 3 minutes remaining, and I would like to give each of you 45 seconds for your concluding remarks. And I would like to start off with Philippa, and yeah.
Thanks. So I think we need to make this an imperative for everybody, and you do that by baking sustainable thinking, climate responsive thinking into the governance of capital markets, so that profit and purpose isn't a choice of one or the other, but it's both. I think that voluntary carbon markets and some of the steps being taken in that direction are great, but we need to think broader in terms of how investors can fund mitigation and adaptation. And we also need to look at the private asset side. So a number of panelists have touched on MSMEs and how we make sure that we're funding earlier stage organizations and how that bakes into capital markets as we develop them. And finally, collaboration is key. Thank you.
Thank you. Victor?
Thank you, Sephutile. I think quite a number of issues have been discussed today. So the issue of capacity, I think that has been brought out very clearly by Elizabeth. And this is capacity to both the regulators and both to the market actors themselves and the different financial institutions for them to understand that. The issue also that sustainable finance instruments introduce new products to the market. The green sukuks I've spoken about, the gender bonds, the green bonds, and all this really introduce new asset classes that are very key for the market. It's one thing to have regulation in place. For example, in Kenya, you have the rate ceiling that was increased to 30%, but only 0.02 is invested in rates. But we helped issue the first corporate green bond in Kenya, and it was for student housing, green student housing, and that has done so well. And this company has come back for a second issuance, and now we have these green student hostels coming up. Most of the universities in the country have signed up with the developer who's building the green hostels, and simply because half of African population is now living in cities, and the demand for education is up, the demand for energy is up, the demand for having cleaner cities is up, and so these are actually tools that are practical and will help change the way we are living as a society. Thank you, Sephutile.
Thank you, Dr. Dalal. 10 seconds.
Thank you, Sephutile. No, in a very briefly, I think we all realize the importance or the emergency of taking action to mitigate all the sustainable development challenges we have. And sustainable finance should be a key priority area in national agendas, financial sector blueprints, and it should no longer be a nice to have, but a priority focus area for all governments.
Thank you. Thank you all for joining us. Thank you to our panelists. We hope you'll continue to join us on day 3 of Pathway, and goodbye.